In this video, I want to show you how to calculate the variable overhead efficiency variance. So let's say that your company manufactures soccer balls and your top management has set the following standards. Your company should incur $24 per machine hour in variable manufacturing overhead. So every time there's a machine hour, it should lead to $24 in variable manufacturing overhead expense. And we'll just say that this machine hours is the activity base that your company has chosen. It could also use direct labor hours or a different activity base, but let's just say that's the activity base for this example. And so another standard is your company says it should take 0.7 machine hours to make one soccer ball. Okay, so every time you make a soccer ball, it should take 0.7 machine hours to do so. During the period, in terms of what actually happened, your company incurred $200,000 of variable manufacturing overhead, and you produced 14,000 soccer balls, and it took 10,000 machine hours to do that. Now we have enough information to calculate our variable overhead efficiency variance, and here's how I like to set it up. So we've got our actual hours times the standard rate, and then we've got the standard hours times the standard rate. The difference between this and this is our efficiency variance. So let's go and start plugging in some numbers here. So for our actual hours, we have 10,000 machine hours. That's just in the given information right here. Now the standard rate, that's also given, that's $24 per machine hour. So 10,000 times 24 is $240,000. That's the amount here. Now, our standard hours. Now, we actually have to do some calculations here. As we say, okay, look, it was 14,000 soccer balls that we made. And it was supposed to be 0.7 machine hours per soccer ball. So we multiply by 0.7. Okay, and that gets us 9,800. 9,800. This is saying that it should have taken 9,800 machine hours to make 14,000 soccer balls. Okay, that's our standard, that's our SH here. So then the standard rate, that's just the same as before, that's the $24. Now, if you multiply the 9,800 times 24, you get $235,200. So now we compare this, the 240,000, to the 235,200, and you'll see it's a difference of $4,800. So our efficiency variance is $4,800. Now the question is it a good thing? Is it favorable? Is it unfavorable? Well, let's think about it. It should have taken us, per our standards, it should have taken us 9,800 hours to make this many soccer balls, to make 14,000 soccer balls. But it in fact took us 10,000 machine hours. So it took us an extra 200 machine hours to make these soccer balls. So the question is, okay, well, is that a good thing or not? Well, that's a bad thing, right? So we'll call that an unfavorable variance. I'll put a little U here. So we have a $4,800 unfavorable variable overhead efficiency variance. And so we could look into it if we, 200 machine hours isn't necessarily a whole lot, but if we said, it's worth investigating, it could be possible that maybe some of the material that we were machining to make the soccer balls was defective, and so then we had to use the machines even more because we had to go back and make redo time that we had already been making soccer balls and replace the ones that were defective. Maybe that's why. But if we want, we could go and investigate. Remember, just a variance is just a red flag that there's a potential issue. Now, if you want to calculate the total variance, then we can calculate the spending variance here. And I've got another video on it, so I'm just going to go through it quickly. It's 10,000 hours times $20 an hour, which is 200,000 total right here for the actual hours times actual rate. So the difference between 200,000 and 240 is 40,000. And this is favorable spending variance. Okay, so if we net together our 40,000 favorable spending variance and our $4,800 unfavorable efficiency variance, that gives us a total variance of $35,200. And that's a favorable variance. That's our total variance. But again, our efficiency variance is 4,800 unfavorable.